Mr. Kwas, good morning. How was your weekend, sir?
It was excellent.
Great.
You can see this background is not fake behind me, and actually you can kind of see CNBC in the background. Sorry about that.
CNBC, get that off.
Right, I'm up in Steamboat. I haven't been here in a while, and I immediately lost weight because I jump on a bike and burn a bunch of calories. Plus, did you see the blood moon last night, or was that too late?
Oh, I forgot. Darn it. I always forget about that stuff, Tim.
It was spectacular. I was running around snapping photos. I mean, it's pretty hard to get a good shot of the moon with a phone, but I gave it my best effort. It was really a spectacular thing to see. We had a perfect view here in the mountains of the whole thing happening. It was just terrific.
That's cool.
Takes your mind off the Bitcoin.
What is a blood moon? Like, why does that happen? What's the science behind the blood moon?
It's a bearish indicator, Dennis. It's a bearish indicator.
Oh yeah. What's the science that causes the blood moon?
Right. It's actually a consequence of what has been happening in the equity market. That the blood moon is just a reflection. Technically, the explanation for it is that when the sun, the earth, and the moon all line up, they block the blue light, and so the only light that shows is light that has an orange or red hue, and that's why it's called a blood moon.
There we go. Good lesson.
See, Tim teaches us everything.
Yeah,
market structure, science, everything.
There we go. Tim, what's in store for the week? We've been asking on this show whether Thursday was the bottom or not. At least for the short term, it appears to be that way. What is your sense as to the answer to that question?
Well, it's so I used this analogy in the market desk note for Edge users this morning. That have you seen one of those thriller movies where our hero is poised with a pair of pliers over a bomb that is ticking down to zero?
Oh, yeah.
And he's trying to figure out, do I clip the red wire or the green wire? And it's
I like that analogy.
It is like that because there's good news and bad news. So I said last week, to self-congratulate, to quote myself, I said that if the market was going to recover, it would happen on Friday, because that would be 5 days out from this week, Thursday, May 19th, index options and futures expiration. So if you're going to make a play into an expiration state, 5 days is like 82% of the plays. It is the most popular trade by far for hedge funds, quants, and so on. Plus, Friday was the benchmark for Russell rebalances. We could see the evidence of that. So that whatever happened on Friday, that's the benchmark, which I think, wow, we're not going to actually do the rebalances till June. So what if we have tremendous tumult between now and then? But anyway, Friday was the benchmark for that. Then today would be 5 days into Friday afternoon options expiration. So once again, if the market is going to rally, and notice how the futures turned around, it will rally today because there is a bet. Then I don't know. Here's the interesting thing. So I was looking at, as I do, as is my custom, market structure data yesterday, and I looked at the entire data set that we have. And we built these algorithms in 2010, but the ones that we use to calculate sentiment, but we didn't have a very good data set. So we use a data set from about January 2012 to current. So it's a decade long. And we look for, weak tops precede drops. It sounds like a quaint little phrase, but it's something we look for. If sentiment peaks weekly, that is, it doesn't have a lot of enthusiasm, that precedes big declines. And the weakest top in the data set that we have until now was in late October 2018. And that preceded the complete crap kicking that the market took into December and January 2018, 2019. Then the Fed backed off of its tightening policies. Remember that? And then the market took off like a rocket ship. So save for that and a brief little blip in March of 2020, the sentiment measure that we have now is at its weakest top. So Could we have a nice little rally into expirations and then another step down? Well, it's the data would suggest that that risk exists. Yes. So there's your red wire and green wire.
I just want to make a quick note on the Russell rebalance. So June 3rd is actually the important day, because that's the day that they're going to publish the list of all the stocks that Russell is adding, FTSE Russell is adding and removing from their Russell indexes.
And then it feeds through for 3 more times before we get to the final.
Right, but
June
3rd is the day that if you do trade imbalances like that or in rebalances like that, June 3rd is going to be your day, because that's the day that the first list comes out, and they'll tweak it for that's the day when we get the first list, and that's mostly what it is. So,
and I mean, this list is easily figured out by multiple institutions that log this, because it's just it just goes through, and it goes
not
through
that hard.
Yeah, it's not rocket science to figure this out.
Right, exactly.
Yeah. It was interesting in our data that they always peg it in May and then release the list in June, but that there was about twice the size of movements in the Russell 2000 than there was in the Russell 1000. And it may just be because the volatility in the Russell 2000 is about double what it is in the Russell 1000. So that's the 3,000 largest stocks in the market, by the way.
And Dennis, didn't you say a lot of it has got to the point where you got to figure out where it's coming out of?
Oh, it gets crowded. It turns. It used to be like 20 years ago. You buy all the ads, short all the deletes, put the portfolio on, just bank coin, don't even think about it. And now it goes crowded. They get oversubscribed. I mean, it's just, and then what happens is 2 days before, sometimes it blows the other way where the ads tank, the deletes go up. And I've even seen, days on the imbalance. You think, well, there's, 20 million shares. I got to buy this stock. It's got to go up. Well, 45 million short-term traders were anticipating that. So now you have a net sell of 25 on it.
Right.
So,
well, 20 years ago, you didn't have the market maker exemption to short locate rules. So market makers will just create whatever is needed to satisfy the fills, so the prices don't move the same way. And it brings up an important point about what happened to Terra USD and Luna. The mechanism in that stable coin is the same mechanism in ETFs. It is that you create and you destroy Luna if Terra lags, and you destroy Terra if Luna lags. That's what you do. You create and redeem. It's the ETF arbitrage mechanism, and it failed catastrophically there. And so is the ability of market makers to create stock to fill large institutional orders. That is a mechanism that can lead to catastrophic failure because it's not real. And those, I've been writing about these things for years, and then people poo-poo it because we go for years with no trouble. Then the moment the market starts to go down, we get into real trouble. It's remarkable how volatility explodes when the market tries to drop, because money can get into the market very easily, but not out. And it's not because of people. It's because of the rules and the mechanisms that we have fostered in the equity market that have screwed up that trade, Dennis. The trade used to work well.
There's a lot of trades that don't work well anymore. 25 years ago, Joel would know all those trades from 30 years ago, the ones that used to work. And everything's gamed now to a certain extent as well. I mean, everything's like, okay, we're anticipating, where the flows are going here. In some cases, they don't even have to anticipate. Like we've said, payment for order flow is a huge hedge in itself.
Yes, it is. Right. Absolutely it is.
Hey, Tim, can we take a look at ARK? Have we ever looked at ARK with you, ARKK? Because, you had a turn off the low. Have we ever taken a look at that with you? I mean, it's got to be near a 1 or a 2. I mean,
Joel always loves to
3.
Guess.
I'm
such
short
a gambler.
3.
He loves to guess what it's going to be, and market structure edge, what the number's going to be.
So I hate to dash your hopes, Joel, but we don't. It's for the same reason. It's the Terra USD Luna relationship.
Okay.
The reason we don't put ETFs on the platform.
Because it's not real is what he's saying.
It's not real. It's not real. It's a facsimile.
All right, let's do another one. Let's do another one. How about Netflix?
Well, we can certainly do that.
That's
and by the way,
what do you say, Dennis? I say Netflix is probably like a 3.
I was going to say it's starting to turn though. It's starting to turn higher.
Yeah. 3 from a 1 though, so it's turning.
Yeah, that's where we're going.
It's turning.
It's like a 3 from a 1.
Yeah.
Okay.
Let's see. Maybe it's still a 1.
We'll take a look at that, and then we should come back to this. Notice this Benzinga May 16.
Yeah.
Look at the demand side and the supply side. That's the stuff that you want to trade.
Okay.
So we will come back to that. But let's go look at Netflix. And Netflix is a really interesting example of what's going on in the market.
Survey says
it is a 1.
Wow.
It is a 1.
Still a 1.
Still a 1. So the only reason it has risen, the only reason it has risen is the supply trend. So all the fake stock is coming out, which causes the demand that isn't even rising to lift the price. That's what's happening. And here's the, I'm going to profile this. This is a back testing engine that's built into Edge. By the way, traders, you can use it, MicroStrategy Edge. This is fascinating to me. Let's go back in time. Let's go back to July 1, 2021 and run a couple of scenarios. What if you bought the uptick and sold the downtick in Netflix? Well, so if you just bought and held it, you'd lost 65%. That's buy and hold. But if you bought the uptick and sold the downtick, you still lost 1%. But it's really interesting that you could mitigate your losses, and you used to make money doing that. Buy the uptick, sell the downtick, made 12%, made 7%. Then in October, right before the whole Thanksgiving meltdown, that was the end of the growth market, right? November 15, the November options expirations marked the end of the growth trade. And from there on, you couldn't produce a return in Netflix. You can see those numbers. That will tell you what the net of each of those periods if you just followed the math. And you used to be able to buy 1s and sell 10s and just mint money in Netflix. I used to do it. If it was at 1, I'd just buy it. And when it got to 10, I'd sell it because it just worked beautifully. Well, that trade is a disaster now. So look at that. You would lose more doing that than if you just bought and held it. You'd lose 75% of your value. So the question is, are we turning? If you're a serious gambler, if you have an addiction, you might try that into options expirations. Maybe it's the end of the death of Netflix. I'm not saying it is, but if at this rate, if you got a surge in demand, and it could happen into options expirations, you could make some money. But realize it is very, very risky to do.
What about SPY? Go back to the SPY one.
Okay, so you mean help me out here, Joel? What do you mean?
SPY, the spiders.
It's once again an ETF.
Yeah.
Now we.
I thought you had something up there on the SPY.
Well, we use SPY as our benchmark. Okay. So SPY becomes the benchmark. It's an easy way to run that data. So we will always compare whatever you're trading versus SPY. So could you beat SPY? Well, you used to be able to, but you could just kill the benchmark buying Netflix at 1 and selling it at 10.
Okay.
Now you cannot. You get destroyed. Right? If you bought it on December 3rd at 1 and you sold it at 10, you lost 38%. Now the SPY only was down 20 basis points. But we're always comparing those things when we backtest data. It's just a simple way to do it. It runs really fast, and you can just check your thinking, check your math. But that's not where you want to be, right? So you have a question. Fire away.
All right, Scarjo, we'll do one from the chat. Scarjo Rabbit wants Disney, please.
Disney. Okay. Yep. Also, once upon a time,
probably like one.
5.5 was a great trade in Disney. Buy the rise above 5, sell the return there. Here's where it is. Yeah. So very weak demand. It ticked off of 1, but then topped. That is, it stopped rising at 1.8. Miserable. And then the supply side jumped above the trend. So when the supply side is rising and demand cannot rise, what will it do to price? Well, all other things being equal, price will go down. And until until that condition changes, you just want to watch it. Wait for the supply side to trend down and the demand side to get some footing. I like to see demand above 5 because then you know there's excess demand. When those conditions exist, you're going to make money on Disney. And why waste your money? You could say, well, Disney is a long-term hold. And Dennis, I know you own Disney in your long-term portfolio.
Not doing well.
So why have your money not producing a return for you? Wait until the conditions are going to give you a return. And then what should you do in the meantime? Well, don't trade that. Trade this. I'll show you. So here's what you want to trade. You want to trade stuff like this. Johnson & Johnson, demand rising, supply falling. Verizon, demand rising, supply falling. Ameren, utility, demand rising, supply rising too. Utilities are not as good as they used to be. AbbVie, same condition, but look how low this is. The whole market is 45% short. That's all that manufactured stock. They're only at 35. So that's a huge advantage. Bristol Myers Squibb bottomed at 5. That means it's a very stable, low volatility play. Again, the supply side is rising, but it's at 39%. That's very, very good. Pepsi, 5, 41, trending down. I look at all of those, look at their volatility. Most of those are less than 2% volatile. The whole market is 3.9%, the SPY. So if I want stuff that's going to produce a low risk return with low volatility, there it is. And the math will tell us that. And it doesn't matter what their fundamentals are. The fundamentals do not determine prices. Whoever is trading the stuff determines prices. And that's what we want to be aware of here.
It sure looks like market structure edge is saying that the bottom is not in. It wants us to buy all these defensive stocks.
No.
And in all likelihood, that bet has been a good bet. You know, that has been a good bet in 2022 to say the lows are not in because we continue to go lower. So basically, market structure edge is saying this is a dead cat bounce.
It is, absolutely. So here's short term. Into options expirations, I do think there's an opportunity to make money because of this. Here's the demand side. It's peaking, though. I don't think it's going to rise anymore unless we have a huge day today that changes the nature of the market. So you see the demand side. The supply side is really tailed off. Well, those could give us a short-term move. But I think I fear that a month from now, we could be easily 10 or 15% lower based on this lousy demand side. I mean, again, we'll say it is the worst in the data perhaps that we've ever seen. And now maybe that'll amount to nothing. But as you know, you guys know, one of my favorite phrases is the prudent foresee evil and hide themselves. I would look at that and say, I've got a week to trade maybe, and then I'm going to be very, very careful.
Tim Quast runs Market Structure Edge. Check out the platform. Link is in the description. Tim, always a pleasure. Talk to you again next week.
Always a pleasure with you guys too. Have a good week. We'll see you.